period, when we close out the book, everything reset to 0. Everything reset to 0. And the bottom number, if it is the positive, we say there's a profit. If there's a negative, we say there's a loss. And doesn't matter is it positive or negative. By the time we close the book, we transfer that number to retained earning. Go to equity. Go to equity. So this $25,000 by the end of the day will be transferred to equity. Will be transferred to equity. All right? So far so good. All right? Okay? Okay, let's do one more exercise, then we'll go to the book. So after 30 days, or say within the 30 days, when your company receive $100,000 payment, what should we do? The day we receive $100,000 cash, remember I gave you the hint last time? The tip is whenever transaction involve cash, we pick our cash account, right? So right now, on the day we receive cash, we have cash account. And right now, I think right now at this moment is no-brainer, right? Should be no-brainer, right? Cash is assets, right? Okay, so should be. All right. Cash increase. And which account to match this offset? This $100,000 on credit side. Which account you want to pick to match this cash? Yes, so we close down account receivable right now, right? When we receive the payment from customer, of course, right? No more account receivable for this account. So you're close. Another thing I want to remind you, okay, right now, number one, okay, when every time I put on the T account on the whiteboard, is only for demonstration. In real life, you will not see T account. Number one, okay, because right now everything done with your software in your computer. You don't see T account anymore. That is in the old ancient day, we see T account. So in yeah. Only for demonstration purposes, that's it. Alright? Another thing is, even though we use T account, however, in real life, is continue number here. And right now, I just put on the 100,000 here, but in the real life, next second, probably another number come in, right? Because for your business transaction, you don't do only one transaction in one day, right? You have so many transactions come in. So number one, we don't see T account in real life, and number two, the number is continuing. And for your accounting software, you will record the number, the time, the day, and also the customer destination number. For each customer, you have a designated number. You assign the number there, so you can see on your computer very clearly. Computer give you the report. You will see this $100,000 will bill to which customer, and the next one say 55,000 account receivable. This is another customer. You will see very, very detailed report from your computer report generated by your computer. Okay, so yeah, on the day your company received this $100,000, you have a cash increase. So debit side, then you finish this account receivable. So account receivable on the credit side. So far so good, right? It's okay. So this is kind of idea about income statement. Okay. So all right. Any questions so far? So this is chapter 3. We talk about the income statement. This is a sample on your page 107. This is example, okay? From this company, you will see operating revenue. Operating revenue. You will see operating expenses. You will see operating income. And can you read what are the items under other items? Can you read it? Can you read on this slide?
Income, interest expenses.
Investment income and interest expenses. Okay. Why? Why do we differentiate income from operation from another sources? Why do we need it? Why bother it? Why?
Because they're not part of the operation process. I mean, they are.
For what purposes? Let me ask you. For what purposes we want to differentiate? Income is income. Why? Why should we bother? Why do we bother to differentiate this income is from this from operation and this from investment? Why? Why do we bother it?
We want to understand how we deal with our core business, how we're successful.
Everybody heard that? Everybody heard that? That is for analysis or for management purposes. For management purposes. Say, for example, you are the restaurant business. You are in pizza business. And 80% for this period, your income from stock market. Then you got trouble. You got trouble. That means you are not really doing a very good job. What are your manager doing? Every day watching the screen and try to buy and sell stock. And the restaurant close the door. The customer come in and say, close the sign there, right? So that's really for our analysis purposes. For the top management to supervise, even though, oh, by the way, back to my example. Sometimes even the manager doing very good job from the earning still being fired. Why? Not doing the right job. Maybe the number is good, but not the right job. All right. So for the analysis purposes, we want to look at what is the major revenue from operating, because for this example, it is a restaurant business. So of course, all major revenue should come from restaurant business. You can do a little bit investment, you know. You can do the lending to earn the interest, you know, but that is not the main job. So that's the reason why for the again let me put this way. If this is your one man company, nobody care. Okay, this is your one person business, and you say my business is to operate the business as a restaurant, but for 7 days you close the door and you just watch the screen to do the stock market. Nobody care. Nobody care. However, for the regular business, your top management really want to see, are you doing the right job? Okay, that's only for the analysis purposes. So for your own business, you don't differentiate this fine. Remember what did I say last time? For this class, okay, when we finish the whole semester, I really want to see everybody, each of you, at least you can prepare your balance sheet and your income statement. Could be very, very simple. Okay? However, that's one of my goal. For each of you, in case you are running your business, for next semester we'll talk about this. Okay, we'll talk about business model. And assuming you are run your own business. And very beginning, okay, very early stage, when you deal with your landlord, when you deal with your banking, okay, the bank manager, they may ask you to provide financial statement, and you don't sit in there and say, what I'm talking about. And you know, okay, when people say financial statement, you mean you need to prepare your balance sheet, you need to prepare your income statement. It is not necessary to prepare very complicated like this. You don't have to. For your balance sheet, you just showing assets how much and equal to liability how much plus equity. This is it. You pass, okay, as long as the number is correct. For the income statement, you just need to mention for this period how much revenue minus your expenses, and you see your profit. This is it. This is it. That is one of my goals. And everybody can see the bottom line. What's that? Very bottom. What's that number? On each income statement, at least for this example, okay, you see the number there. What's the number? Very bottom. Everybody see that? Can you tell me what's the number? What's the name of the item? Is EPS. EPS. So every time you heard about this, you heard about people talk about EPS, you know what it is. Earning per share. Assuming this is a corporation, by the way. Okay? If this is a LLC, we may say earning per unit. Different terminology, okay? Yeah, we will talk about the business organization for those people you have not taken my business law or entrepreneurship. We will talk about a different organization. Assuming this is a corporation, we say earning per share. If this is LLC, limited liability company, we say this is earning per unit. If this is a partnership, we have another terminology. All right. So that means for this enterprise, it is a corporation. As a corporation organization, each investor will receive the certificate, will receive the stock certificate to prove how much percentage interest this person is holding. All right. So that is divided the total outstanding stock. Total outstanding stocks. For example, for small business, you only issue 100 shares. You just issue total 100 shares right now, and this person is holding 15 shares. And then the total profit divided by 100 and time 15, and that is what total profit this stockholder can share. So EPS is very important number here. Following this number, okay? On this day, August 17th, okay? The last day of this class, we'll allocate at least 30 minutes to talk about different ratio, okay? Eventually, in each chapter, there is one or two major financial ratio in the book. However, in order to save our time, we will not cover it too much. Okay, we will reserve that portion to our last class. However, I need to mention this. Follow out EPS number, there is another very important number. You may hear about it before. That is called PE ratio. Very important indicator, okay? I bet. Doesn't matter you are in the stock market or not. You read this, you heard this before, for sure. Can anybody tell me what PE ratio is? Or you never heard about it before? You never read it before? Or you did? Anybody can tell me what PE ratio is? Hold on 1 second. I want to give opportunity to somebody else. What's P mean? No, P is not profit. P is price. Stock market price. The price change every day, every second. There's a stock price. Especially that's for the public company. If this is a private company, probably there's no PE ratio. But for every company, there is EPS. Got it? For any kind corporation company, there is EPS. If the company lost money, no EPS. Because E means earning. When the company incurred a loss, then we forget it, no EPS. So the EPS cannot be less than 0. Okay, when the company incurred the loss, we skip this, no EPS. For public company, we will go from EPS to calculate PE ratio. P mean current stock price. At this moment, what is stock price? If you are the stock market investor, you watch stock price every second. You watch the screen. And oh, by the way, I have a few, either my friend or my former student. I'm not quite sure you heard about this before. Some people, they are so smart, and their job is not just watch the stock market. They design software. They design software and to follow out the stock market change, and the software will help you to place the order, to sell or to buy. And the software just watch and react 1 of nanosecond, changes so quickly. And the people told me every day they just rely on the stock, they can make more than $10,000. Because the software just watch and follow the stock market change. Okay, and to put the arrow, to place the order, to buy or to sell. And they just make the profit so narrowly, but the quantity is so big. And I was told, okay, they can even make more money, but they don't want to because they will be watched. If they make money too much every day and place the order too frequently, SEC will come in, the IRS will come in to investigate. And those people are so smart. Okay. By the way, that's not our issue for today. But the issue is, in order to make the money from stock market, the price is the fundamental issue. You need to know when is the timing to buy and when is the timing to sell. And for the regular people, we just buy and sell, probably just put there and don't do anything. But for the professional people, just more like a gambler, okay? They put the sales probably in the morning short, and by the end buy back, or opposite. And they make this decision so quickly. And the P issue is to justify whether or not the price is too high or is good deal to buy. And usually, okay, not necessary. Usually, for the financial analysis, for the financial advisor, for the financial market, usually the golden rule is around 20. It's around 20. That means if the price is around 20 times of your EPS, still okay. So let me give you an example. If one company can calculate, receive the EPS is about $1, that means each share for the whole year can make $1 profit, then the stock price should be around 20 or less. Got it? Got it? So let me say it again. P ratio is the number to justify whether or not the stock price is too high, way high, or is below that below the regular industry standard, and it's a good buy. It's a good buy. It's a good deal. So usually industry say 20 times. The price is not more than 20 times of your earning, it's okay, still okay. But right now for today's stock market, because it's record high, even though last week it will be changed, but right now still in this period, stock market is still in the record high. So if you check those very popular stock, okay, after today you go back to check the P ratio, not surprised. It's like a 50, 70, even more than 100. And guess what? When you see generally P ratio is so high, and maybe that is the signal market may crash. I don't worry about market crash right now because we just gone through like 3 years. We just gone through the 3 years downside, and the stock market just come back like around say 15 months. So even right now, all stock market is record high, even the P ratio is so high, I don't worry about crash, bubble burst, not too much because we just gone through the bottom. However, always watch the P ratio is maybe the signal. Can you imagine people would like to spend 100 times over the earning? This speculation. This is more like gamble, right? How can you justify you spend $100 to buy $1? Because when you spend 100, your return is only $1. Unless you expect somebody will pay you 105. You got a point? If today I'm the seller, I tell you already the value of this digital recorder is only $1. I told you already, it's only $1. You say, Professor Tong, doesn't matter what you told, I will pay you $100. Does that make sense? No, it's not. Unless you expect when you spend $100 right now, another body will pay you 105. That's only reason you will pay so high. But that's called speculation. That is called speculation because the value on the item itself is not worth that much. So when people go crazy, right? Always, we go crazy, right? And that's what the market does eventually. That's what the market does eventually. So that's why if you are already investor on the market, P ratio is a guideline. But you know what? When the market go crazy, people don't care about P ratio. We don't care about P ratio. We care more about speculation. Everybody just bet. Doesn't matter how high the money. Oh, by the way, if you still remember back to 2000, the P ratio of Yahoo, of AOL, those internet, the P ratio is 300 to 500. 300 PE ratio, 500 PE ratio. Even PE ratio is 300, the financial analysis still say you will go up, you will go up, you will go up. Just crazy. It's just crazy. Alright? So at least right now we know what EPS is. We know what P ratio is. Alright? So we will go from there. Okay, we will see next slide here. Accrue method. I mentioned this over and over again. This is on your page 110. Accrue. ACCRUAL. Accrue. Accounting. And for this whole book, for this whole semester, our assumption is your business is on accrued method, accrued basis. Again, I mentioned this, right? For your final project, you can pick up this topic because a lot of things you can talk about. Okay. Accrue method means not necessarily cash involved, just like the example we went through. Okay, when the transaction happen, then we enter our bookkeeping. And again, for small business, we don't bother it. For small business, cash method is a lot easier. Another chart for you, page 117. Same thing. Okay, this page 117 is the same thing like the chart I put up every time, every week. I will put this chart on the right side. Okay, same thing. We have assets, we have capital, we have liability, we have capital, then we have revenue, we have expenses. Okay, I think this is one example we just went through. Let me see anything I can add on. On your book, this is page 118. You have book. So very similar example. I think right now we should have no any trouble to do it. This company sold the merchandise, made the sales $66,000. Okay, your company just delivered the merchandise $66,000, and this is a mixed example. Receive cash 7,000. Account receive. Receive cash 57,000, and account receivable 9,000. So I think we don't need to spend too much time, right? We have the revenue. For this example, okay, it put down the revenue to equity directly. I don't care. I don't care. Okay, you can separate it as a revenue category or as a equity, because the revenue finally will become the equity. But I prefer separate it. Personally, I don't want to put the revenue under the equity category, but it's okay. Okay, fundamental concept is the same. All right. So we have a revenue increase. We have a cash increase. We have a receivable increase. The next one, let me see. The cost of the inventory is $30,000. So you can see it deducts supply. Supply here almost equivalent as inventory. Okay, different business use different name. So supplies here is almost like inventory. And we have cost of goods sold here, $30,000. Oh, next one is big item. If you have book, okay, it's on page 118. Okay, this company sold, received $400 cash received because it sold the franchise. However, this $400 cash will cover totally 4 months period. Okay, let me read it carefully. Okay, when your company receives total $400 cash, however, $400 will cover total 4 months franchise benefit. So here we got a problem, right? We cannot enter into total $400 revenue. We cannot do that. I want to make sure everybody follow me. Okay. So we have cash $400, but when we receive $400, only 100 is the revenue. Another $300 is for the future revenue. We just receive our customer prepay to us. And I believe I mentioned this last time. When we receive the prepayment from our customer, that portion will become our liability. There's a name for that. It's called unearned revenue. Alright? So be careful when we receive something covered for the future sales. So I think there's no problem, right? We receive 400 here. So cash increased by 400. So this is fine. So remember, for each transaction, we need to pick up 2 or more tier accounts. So for this example, we need to pick up 3 tier accounts. So 400 for cash, no problem, right? I want to get an agreement from everybody. So this is the easy part. When we receive 400, cash is cash. So our cash increase, right? How about revenue? How much you want to put in the revenue? I told you, right? Only 100 is the revenue for this period. So we can only put on 100 here for this period. What happened to the balance? How can we do that? How should we do that for those 300? We know 300 must be credit side, right? Because this is only one, so we need to pick out another account which shows 300 on the credit side. And I told you already, the name of the account is called unearned revenue. Unearned revenue. Unearned revenue is liability. Remember, I say always we have 3 steps analysis, right? We pick out the name, unearned. So step 1. Number 2, more difficult. We need to put unearned revenue under liability. Step 2, analysis. Step 3, is this liability decrease or increase? Here it is increase. So when you see increase, you see chart, right? So we have unearned revenue. This is a liability. So when liability increase, it is on the credit side. Any questions so far? So good, right? So far so good, right? How about by the end of next month? By the end of next month, we earn another $100. So by the time we do earn this $100, what should we do? Yes, very good. We move this amount from unearned to earn. Earn means revenue. Okay, so by the end of next month, we just increase another here. How about on the debit side? How about to match this 100? Yes, right? Everybody, right? We should deduct this unearned amount. Right? Remember on the chart, you see, when liability decrease, it is on the debit side. So by the end of next month, we do earn, so we have revenue increased by 100, but this amount 300 decreased by 100, right? So we put down on the debit side. Same thing, you just repeat this every month. And by the end of 4 months, it becomes 0. And every month, we have a revenue increased by $100. By the way, okay, let me change this whole scenario a little bit, okay? If I change the whole scenario, okay? your company received $400 cash. Okay, your business received $400 cash. But that $400 is only for security reason. That's it. That's only for security. For example, your client want to rent your equipment, rent something, rent furniture. They will pay the rent separately. So the rent will become the income. There's no problem. But on the top of the rent, you require them to pay you $400 cash as security. And by the end of the rental period, once they return the merchandise, everything still keep in the good condition, and you obligate to return this $400 as a security. So by the time you receive this $400 cash as a security, no problem, okay? Easy. Again, you have a cash increase by $400, so you debit it. However, as a security payment come in, what category you need to pick? As a security. Am I clear so far? Am I clear? I just want to change the scenario, so give you more opportunity to exercise. Same thing with right now we receive 400, right? But right now this 400 is not prepaid. It's not prepaid. If it's prepaid, we use this as process. But right now this 400 is for security deposit. So for cash part still the same. We receive 400, so debit cash by 400. But right now this 400 is only for security deposit purposes. And by the end of the period, if nothing damaged, we obligate, I give a hint already, we obligate to pay back. So we need to pick out what? Step one, we pick out, say, security deposit or what? Something like this. And step two, this account belong to which category? I know, always step two is trouble. Liability. It is liability. It is liability. Why? Because we are obligated to pay it back. So, okay, by the way, everybody. Yeah, Colin.
Did you also look at it because it's an increase on the right-hand side?
Yes.
And the three accounts
Yes.
where there's an increase on
Yes.
the right-hand side?
This is another good analysis, right? If you are sitting there, you are really trouble to see, oh my gosh, professor told me already this is a tough part. It is tough part. Okay? And then this is another analysis, right? Because you need to pick out one account must be increased on the right side. And there are only three, right? Could be liability, could be equity, could be the expenses. It cannot be expenses, right? You did not expense, you do not spend anything, right? Cannot be expenses and cannot be equity, right? Because this guy does not become your owner, right? This guy does not become the owner of the business. So you don't have any other more choice. It must be liability. It must be liability. So, you know, at the beginning, okay, as a beginner of the accounting student, you may have difficulty to pick out the step two analysis. I know, but college just give us one guideline, right? Because, you know, 2 out of 5 or 3 out of 5, they are mutually excluded. They are mutually excluded. So you only have 2 or 3 to pick. And if you sit down there and say, not this, and the very last one left, there, this is it. Got it? So far so good, right? So far okay, right? How about by the end of the period, when this customer return the rental merchandise, and you find out there's a damage, and you both party agree the damage value worth $200. So by the way, let me finish this, okay? So by the time we receive this $400, we know this is a security deposit, right? So we say we have a liability. And say security deposit here. So this is the day when we receive this $400 as a security deposit, okay? So you enter into two-tier account, right? So we have cash increased by 400, debit side, and we have a liability increase. So on the credit side, 400. So far, no problem. However, by the end of the period, when customer returned the equipment and we found there's a minor damage, and we both parties agree upon the damage value is $200. So the customer agreed to pay you $200 as a recovery. That means you just return 200 back from the security deposit. So at this moment, your company pay out $200 cash, but what is the other account or the other category you need to match to get the whole thing balance? So always start from the easy part. The easy part is $200 cash. Okay?
So the subtraction of 400 on the liability.
Yeah. But for the tier account entry, for tier account analysis, we always pick out the easy part, right? Because at this moment, your company pay back $200 from the cash account to this customer, right? So for this transaction, your company pay. So when the cash pay out, right? You have this. So far so good, right? Then here, this is tough part. This is tough part. How much money you want to put on here? This is tough. You are sitting there, scratch your head. Or better off go to Santa Cruz. Enjoy. Then 2 hours after you found out your answer. So, okay, let me tell you what. Okay, you want to put on here. You want to put on 400 here. Don't worry about that. Because you want to close this account. So be very brave, okay? Go ahead, do it, okay? 400 here. Okay, it's not balanced. It's fine. We find another way to balance it. How can we balance? We have a debit 400, but we have only credit 200, right? We need to balance it. The way to balance is to find another account, put down. Okay. This is not the only way.
Yeah.
This is not the only way, but this is one of the way. This is one of the way. So, Carla, you can tell us another way.
Could you have an account on the liability side that's equipment repair fund, and you put that $200 in?
Yes. Yeah. There are so many ways to do it. There are so many, because you may not want to treat this as a revenue, because revenue is subject to tax. It's not good. Understood? As Carla said, you don't want to put down under the revenue, but anyway, you must put this on the credit side for sure. You want to put this as, for sure, right? So you can put on this as, we'll talk about that, okay? As